order. In a matter of months, the Congress will begin a debate unlike any in recent memory. This will be a make or break moment for the federal budget and for America's middle class. Certainly, there are very different ideas among members of the Senate on how to move forward. Donald Trump is effectively waging class warfare against typical families on behalf of himself and the ultra-wealthy. The question is, how does he do it? He starts off with sweet-sounding campaign promises. No taxes on tips or Social Security. China's going to pay big tariffs. Numbers like nobody has ever seen. But it's really bait and switch. Here's the real plan. First, pass another round of enormous handouts for the ultra-wealthy, financed in part by new taxes that hit working people. Second, balloon the deficit to unprecedented size. Third, make it impossible to save Social Security or address middle-class priorities like the cost of housing and child care. That is the economic agenda. 1, 2, 3. The big winners are people at the top. Everybody else's needs are shunted aside. Donald Trump wants Congress to spend $7 trillion on tax changes that would make the 2017 law look modest in comparison. His starting point is making the 2017 law permanent. On its own, that is horrendously skewed in favor of people at the very top. For every dollar in tax cuts that would go to a family of modest income, the typical millionaire would get a break of $540. Somebody at the very top would get more than $2,000. It's always the same Trump playbook. Donald Trump tosses out a bit of chicken feed to the working people, and the ultra-wealthy like him pocket huge gobs of cash. He also wants another big payday for giant corporations, cutting the corporate tax rate down to 15%. Yet another big giveaway at a time when so many of these corporations are pulling in huge profit. Donald Trump doesn't have a viable plan to pay for these reckless policies, these handouts. His only proposal to close some of the gap is a tax on nearly all consumer goods. Now, Donald Trump keeps saying that other countries are going to pay. But that's not economics 101. Americans who are struggling to get by are going to be on the hook for Trump's handouts to billionaires and corporations. In my view, that is an appalling proposition. Even with the new tax on typical families, Donald Trump's going to run enormous deficits. When Congress gets around to looking at Social Security and the housing crisis, it's going to find that the Trump class warfare has devastated the budget and made it impossible to come together and pass real solutions. Now, Democrats want to take a very different approach. Our view is, and this has been my position since the days when Bill Bradley, a far better basketball player, and I agreed on this, we want a tax code that gives everybody in America, everybody, the chance to get ahead. There's no getting around the fact that the expiration of much of Trump's 2017 law represents a big hurdle. And beyond that, there are new challenges to address. Certainly, the cost of housing and raising a family are at the top of the list. And I'd submit that every member of this committee is hearing about those issues. The reality is there is no way to address all of these issues, housing and family expenses, without ensuring that those at the very top pay a fair share. Now, if you're at the very top and you want to pay no taxes forever, all you really need are 3 words, just 3 words: buy, borrow, and die. Here's how it works. An ultra-wealthy person, an investor, uses their riches to acquire valuable assets. Then that investor watches them appreciate, and they borrow against that value to generate cash. Then that person sits on the assets, enjoys all the cash they've been able to pocket, and when that person dies, any tax owed on the increase in value disappears into what I call the ledgers of history. Now, that kind of trickery isn't available to nurses and firefighters and people in the trades. Their taxes, folks, come out of every single paycheck. The ultra-wealthy have got their own special set of rules. That's how billionaires can pay an average rate of 8% on the income they enjoy, far less than a typical middle-class family pays. I want to make it clear that I understand completely the importance of ensuring that people are successful in our country. And nobody should want to punish success. But also, you shouldn't punish middle-class work. That's what the system does today. The United States ought to have a tax code that's fair and that rewards success at the same time. No free rides, colleagues, for anybody. And that includes billionaires. Let me close by saying we've also been looking here at the committee at other tax dodging schemes that people at the very top are using. One example is private placement life insurance, a tax shelter that really has nothing to do with life insurance at all, colleagues. Grantor retained annuity trusts, what are called GRATs. Mega IRAs that are abusing savings vehicles in ways Congress never intended. Large and extremely complicated partnerships that are structured purely for tax avoidance. The Congress needs to address also the pass-through loophole that Donald Trump created in 2017. Now, Donald Trump claimed it was all about small business. Small businesses have our support. Unfortunately, that Trump policy was also a bait and switch. It became another Trump policy that made the biggest winners out of high-income individuals, all of those real estate and oil barons, all of them won. Those high earners don't need yet another break. We support the small businesses. We support people, as I say, who want to be part of an America where everybody gets ahead. And we're going to stand by the pledge to protect those with incomes under $400,000, and that certainly applies to small business owners. A lot to talk about today. I look forward to hearing the views of all my colleagues. Senator Crapo.
Thank you very much, Mr. Chairman. And this hearing is a timely hearing on one of the more critical issues that will face our nation next year and, frankly, is facing us right now. We'll have an opportunity today to talk about the reality of the 2017 Tax Act, which is the focus of the debate next year, and what it really does. The reality, contrary to what is often said by my colleagues on the other side of the aisle, is that the TCJA, the 2017 Tax Act that was put into place when the Republicans and President Trump controlled the Congress, has had a massive effect positively on everybody in America. The economy was the strongest, grew to be the strongest economy, I think, in any of our lifetimes. Unemployment was down at historic lows. Wage growth and job growth was increasing month after month. Inflation was at 2% rates, and we were moving ahead rapidly and strongly. Americans today, though, are rightly concerned about rising costs of living, slow job growth, and unemployment rates that remain above 4%. Not to mention the inflation rate that cumulatively over just the last 3.5 years is now, I believe, well over 20%. Taxpayers already face too much uncertainty as they look to work, save, and invest in this economic environment. And given the litany of tax hike proposals on the table from my Democratic colleagues, no area is more uncertain as we head into this election than tax. When it comes to 2025 tax policy and the debate, those proposing all of these tax increases continue to avoid a fundamental question. Will they allow the Tax Cuts and Jobs Act to expire and inflict multi-trillion-dollar tax hikes on the American people? That's the question. Vice President Harris largely has avoided the policy specifics and has adopted rhetoric about taxing the wealthy and corporations, which ignores the reality of what our current tax code means for middle-income taxpayers. The TCJA lowered tax rates across the board, providing trillions of tax dollars in savings, with the middle-income taxpayers receiving the largest proportional benefit of these cuts. That's the reality. It also doubled the standard deduction and doubled and expanded the child tax credit, which made the tax code simpler and provided targeted tax relief for the middle class. If these provisions are allowed to expire, individuals making less than $400,000 per year would face a tax increase at the end of 2025 of more than $2 trillion, breaking the Biden-Harris pledge not to impose more taxes on the middle class. And that does not even account for inflation. By the end of this year, that pledge would need to be increased to nearly $500,000 to account for the crushing inflation that families have experienced under the Biden-Harris administration. The pledge also ignores the marriage penalty for couples who together make more than $400,000, but who, if filing separately, would be well below it. Despite her promise to those starting businesses, Vice President Harris has also not addressed the 20% deduction for pass-throughs, the chosen business form for 95% of American businesses. Small business owners have repeatedly said that extending this deduction is their top priority. I said small business owners and top priority, stressing that it enables them to create new jobs, pay their employees more, and reinvest in their businesses. Unless Congress moves to extend these provisions by the end of next year, taxpayers in that category of our economy would face the largest tax increase in U.S. history. Despite critics' rhetoric that the TCJA was simply a tax break for billionaires, the law provided a tax break for 80% of Americans and actually limited tax breaks for the wealthy by reducing costly deductions. For example, the TCJA limited the state and local tax deduction, or SALT, effectively a subsidy for many high-income residents in high-tax states like California and New York. In stark contrast, the Senate Democrats have pledged as recently as last month to end the SALT, which even the left-leaning Tax Policy Center said would overwhelmingly benefit high-income households. By endorsing the Biden budget, Vice President Harris is calling for $5 trillion of tax increases on Americans, which would clearly hit Americans across the income spectrum and hurt job creators and workers across the country. Tax hikes on individuals and families, tax hikes on small business owners, including a top pass-through rate of 44.6%, which amounts to a tax increase of more than 50%. Tax hikes on corporations, and we all know that the burden of corporate tax rates are paid by workers, consumers, and retirees. Tax hikes on savings and investment, and another round of supersized funding for the IRS audits. Again, these far-left proposals are often presented under the guise of taxing the rich and paying one's fair share. But facts matter. And it remains indisputable that most of the federal tax burden is paid by high earners, and the federal tax collections are at near all-time highs. In fact, the TCJA made the tax code even more progressive, with tax rates for high-income earners actually increasing, while the bottom 50% of earners received the largest reduction in average tax rates. This Biden-Harris administration has repeatedly and falsely claimed that the federal tax rate for high-income earners is only 8%. But the Joint Committee on Taxation recently confirmed their average rate is quadruple that amount at 34%. As this committee considers tax policy in the year ahead, the American people deserve more than empty platitudes and $5 trillion in tax hike proposals that even a fully Democrat Congress could not pass. They deserve careful deliberation of policies that will provide economic growth, tax certainty, and opportunities for all Americans. I'm committed to helping all hardworking taxpayers get ahead, and I will work with anyone from either party who's ready to focus on that priority. We have an excellent panel before us today. I thank you all for being here, and I look forward to hearing your testimony.
I thank my colleague, and I'm just going to give a brief rejoinder on this one matter of this so-called analysis that is out that says the highest earners pay a 34% tax rate. I would just urge Americans to not be fooled here. There's nothing new or surprising. The devil is really in the details. This analysis that I gather people want to cite excludes the vast majority of the income of the super wealthy. Billionaires don't earn income the same way as firefighters and teachers. So this funny math that is being spread around with respect to high earners pay a 34% rate, this is funny math you come up with when you ignore buy, borrow, and die. When you take into account all of the income that the super wealthy enjoy, we know that billionaires are only paying 8% in taxes, far lower than working people are paying from each paycheck. And the reality is, you can't get this job done right by ignoring these realities that really reflect an accurate analysis of what the super wealthy pay. The top 1% in America holds 31% of wealth in this country, and I think that has got to be part of the equation. I look forward to talking to my colleagues about this in greater detail, but this idea that the highest earners in America are paying a 34% tax rate, this is the funny math you come up with when you ignore buy, borrow, and die, which, as I've talked about in this room, is a glide path to the people at the very top paying no taxes forever. And we're going to be discussing that, and Senator Crapo and I will have a good debate on that, and that's, heaven forbid, sort of the way good governance takes place, when you debate it. Okay, one little bit of business, and then we'll introduce our guests today. We're very welcoming of George Helmy today. He is our new senator from New Jersey. I think he's going to be a real asset around here. He and I have had a number of conversations. He has a great interest in health care and a whole host of questions there, and of course is going to be a champion, based on our conversations, of the idea that we've talked about, which is you can have success and fairness in America. Senator Crapo, I know, would like to say something.
Mr. Chairman, I just had the pleasure of meeting George, and I just wanted to join with you in welcoming him to the Senate and to this committee.
So you now have 100% of the bipartisan leadership welcoming you. Mr. Helmy, would you like to say a quick word, and then we'll go on to our hearing?
I will be quick, Chairman. I just want to thank you, Chairman, and the ranking member for your generosity and your kindness. I look forward to working with all of my colleagues on this esteemed committee as a career staffer. It's an honor and a privilege to be in this room. I appreciate the collegiality and the debate that happens in this esteemed institution, and look forward to being an active part of it for the time that I'm here. And thank you all.
Well, thank you. And based on our conversations in the basketball parlance that I like to talk about, it's clear you've come to play, and we very much appreciate that. And
I did appreciate the reference to Bill Bradley, of course, a great New Jerseyan.
What we always say around here is there are two tall guys on the finance committee who play basketball. One of them is in the NBA Hall of Fame. The other was a college scrub. So we keep this in perspective. Okay, let's introduce our guests. We'd like to start by introducing Datta Gupta. He's the Doris Duke Distinguished Fellow at the McCourt School of Public Policy at Georgetown, as well as a fellow at the Roosevelt Institute. Bob Lord is a senior advisor on tax policy for Patriotic Millionaires. We welcome you, Bob. You've been giving us good counsel for years. Jeff Braben is the vice president for federal government relations at the National Federation of Independent Businesses. We've worked with you all often. And our final witness is Daniel Bunn, the president and CEO of the Tax Foundation. I saw Scott Hodges got a new book out. Get through that before too long. So thanks to our witnesses for being here. As is customary, your prepared statements are going to be made a part of the record. So let's, if you wouldn't mind, take your 5 minutes to summarize, and let's start with our friend from Georgetown. Indevar, please.
Thank you, Chairman Wyden, Ranking Member Crapo, and members of the committee. My name is Indi Dattagupta. I'm a Doris Duke Distinguished Visiting Fellow at the McCourt School of Public Policy and a tax fellow at the Roosevelt Institute. And I'm honored to come before this committee to provide context for tax avoidance by some of the wealthiest Americans and discuss how collecting more revenues from them can strengthen our nation. The United States faces extreme economic inequality that harms our society. Income inequality is near historic highs, with the top 1% experiencing nearly 10 times faster growth in incomes than the bottom 20% over the past 4 decades. Wealth inequality is even more pronounced, with the top 0.1% holding over 13% of total net worth. This extreme concentration of income and wealth undermines economic growth, likely reduces economic mobility, and contributes to political polarization. Research on wealthy countries shows that when income inequality rises, economic growth falls. High income inequality also appears to reduce intergenerational mobility. And research confirms that our growing income inequality has contributed to our partisan polarization. Our tax system has contributed to this situation by privileging income from wealth over income from work. While most Americans receive their income from their labor, the top 0.1% receive most of their income from what they already own. Yet our tax code offers numerous advantages for income from wealth. Capital gains and dividend taxes are at lower rates than the taxes on wages. Gains on assets disproportionately held by the ultra-wealthy are taxed only when sold. And taxes on unrealized gains are wiped out at death through stepped-up basis. As a result, many ultra-wealthy individuals pay very low effective tax rates. By one estimate, the 400 wealthiest families paid federal income tax rates of just 6 to 12% from 2010 through 2018, when including unrealized gains. In some years, some American billionaires do not pay a single penny in federal individual income tax. Policymakers have several options to create a more equitable tax system that raises needed revenue. Fully fund IRS enforcement, focused on high-income taxpayers, yielding up to $390 billion in revenues over 10 years. Tax unrealized capital gains annually for the ultra-wealthy, potentially acting as a form of withholding like the rest of us are subject to. Strengthen estate and inheritance taxes to reduce dynastic wealth accumulation, including by eliminating stepped-up basis, and raise capital gains and dividend tax rates for the wealthy. These reforms would help rebalance our tax code and economy. The revenues could fund highly worthwhile investments to lift living standards across society. I'll provide 3 examples. First, we can ensure a basic foundation for all of us to thrive. A vast array of rigorous empirical studies has demonstrated that such a foundation can help working and middle-class families stabilize their lives, advance in the labor market, and ensure that their children succeed. To achieve these outcomes, we could expand the child tax credit and earned income tax credit to reduce child poverty and boost work. Invest in needed caregiving through affordable childcare, paid leave, and long-term care to support families. Expand access to affordable housing and make health coverage truly universal. Second, we can provide fair access to opportunity, including through much-needed education and workforce development investments that weaken the harmful link between parents' finances and their children's outcomes in adulthood. Third, we can fund climate change mitigation, adaptation efforts, and ensure that our environment supports rather than threatens our health, well-being, and ways of life. Research suggests that our extreme concentrations of income and wealth are holding back our economy. Countries with comparable or higher middle-class living standards like Norway, Switzerland, Luxembourg, and Canada have far lower inequality. The only OECD countries with greater inequality than us have far lower living standards. And income and wealth gaps by race and gender hold us all back. One study estimates that closing racial wealth gaps alone could boost GDP by 4 to 6%. Fundamentally, higher taxes on the wealthy and ultra-wealthy can be fair and efficient and help fuel equitable economic growth that raises living standards for all Americans, all while strengthening our democracy. Thank you, and I look forward to questions.
Thank you very much, and a good way to start off. We'll go next to you, Mr. Lord. Welcome.
Thank you. Chair Wyden, Ranking Member Crapo, and members of the committee, thank you for the opportunity to speak to you today about tax avoidance by the ultra-rich. After a 3-decade-plus run as a tax lawyer, I recently transitioned into my real passion, well, my work passion, federal tax policy. I currently serve as the senior advisor for tax policy with the Patriotic Millionaires, a group of wealthy Americans who use their wealth and influence to try and build a more stable, equitable economy that works for everyone. But it was my career helping clients shrink their tax obligations that gave me insight into just how porous our tax law is and informs my perspective here today. All tax attorneys remember Judge Learned Hand's opinion in Gregory versus Helvering from their introductory tax class. It established a bedrock principle of tax law. There is no patriotic duty to pay tax. Taxpayers are free to arrange their affairs so as to minimize their tax obligations. My testimony today pertains to tax avoidance of the type to which Judge Hand referred, and not to criminal tax evasion or civil tax fraud. So my remarks are not intended to impugn the character of rich Americans who engage in such tax avoidance or the advisors who assist them. But I do think Americans are stunned when they learn that some billionaires face a lower effective rate of taxation than they do. Presented with that reality, they feel the tax law is rigged against them. In my experience assisting ultra-wealthy clients, their concern over taxation was limited to how it impacted their wealth. Unlike for most Americans, tax obligations for the ultra-rich don't impact life decisions. Some ultra-rich clients of mine opted out of tax avoidance. It just didn't enhance their quality of life. That's important. Limiting tax avoidance by the ultra-rich won't keep their kid from attending college, delay their retirement, or inconvenience them in any way. They won't even have to sell their yacht to pay their taxes. They will never want for anything. It will simply reduce the excess wealth they accumulate. The ultra-rich avoid tax largely through strategies developed by highly paid experts like me. Last year, your committee heard testimony on one such strategy, buy, borrow, die, where ultra-rich Americans buy investment assets and never sell them. Instead, they borrow against them whenever they need cash. After they die, their inheritors then sell what typically are highly appreciated assets with no income tax consequence. Avoidance strategies like buy, borrow, die result from exploitation by the ultra-rich of design flaws in the tax system, commonly known as loopholes. One type of design flaw is a rule that assigns vastly different tax consequences to minor differences in circumstances. For example, if a taxpayer sells an appreciated asset one day before his death, he must pay tax on the gain he realizes. But if his inheritor sells that same asset shortly after the taxpayer's death, the gain, potentially in the billions of dollars, escapes income taxation. That's the stepped-up basis rule. It's the loophole that enables the buy, borrow, die strategy. In 2013, Bloomberg News reported on an ultra-wealthy family's use of zeroed-out grantor retained annuity trust, or GRATs as we know them, to transfer $7.9 billion of wealth at no estate or gift tax cost. Shortly thereafter, the tax lawyer who developed the zeroed-out GRAT strategy estimated that wealthy Americans had avoided $100 billion or more of estate tax through GRATs. Closing the GRAT loophole is not complicated. Chair Wyden and Senators Warren and Sanders all have introduced bills that would work. Yet the loophole remains open over a decade after becoming widely known. That should alarm Americans because these are just the known loopholes. As a former tax lawyer, I can tell you tax lawyers do not share our more ingenious avoidance strategies. Early in my career, I saw bipartisan efforts successfully address glaring flaws in our tax code. The passive activity loss rules of the 1986 Tax Act, for example, virtually shut down an entrenched tax shelter industry. More successes like that are achievable, but it's Congress and Congress alone that has the power to close these loopholes. My written remarks discuss additional examples of loopholes, the strategies devised to exploit them, and how they could be narrowed or closed. I'm eager to chat with you more about them. Thank you. I'm happy to answer any questions you have.
Thank you very much, Mr. Lord. I know we'll have some questions. Brayman, welcome.
Thank you. Good morning, Chairman Wyden, Ranking Member Crapo, and members of the Senate Committee on Finance. My name is Jeff Brabant, and I am the Vice President of Federal Government Relations for the National Federation of Independent Business. It is an honor to testify before your committee today on NFIB's #1 federal priority, making the 20% small business deduction permanent. I am here on behalf of the approximately 300,000 small and independent business owners that NFIB represents. NFIB is the voice of small business. The voice of small business is not just a slogan, but a reality that drives the advocacy work of NFIB members and staff. The average NFIB member represents fewer than 8 employees, with about 88% of NFIB members employing fewer than 20 people. NFIB represents every industry in America, including retail, manufacturing, agriculture, and financial services, among many others. I am also here to submit as part of my testimony the names of over 81,100 small business owners who have signed this petition asking Congress to stop the massive tax hike on small businesses. In 2017, Congress passed the Tax Cuts and Jobs Act. One of the most publicized aspects of TCJA was the cut to the corporate rate from 35 to 21%. This benefited small business owners, as over 20% of small employers are organized as C corporations. However, over 77% of small employers and well over 90% of all small businesses are organized as pass-through businesses. This means that business income passes through to an individual business owner's personal income tax. Types of pass-through businesses include sole proprietorships, partnerships, and S corporations. With C corporations receiving a 14% rate cut and pass-throughs only initially receiving a 2.6% cut of the top rate, Congress realized they needed to do something so that small pass-through businesses were not placed at a competitive disadvantage with their larger rivals. Congress wisely decided to create the 20% small business deduction, officially known as the Section 199A Qualified Business Income Deduction. This deduction has allowed most small business owners to take up to a 20% deduction on qualified business income. While qualified business income sounds complicated, it closely mirrors net revenue. The creation of the 20% small business deduction has been crucial to the survival of small business owners. Since its passage, the small business economy has endured many issues, including a pandemic that closed many businesses for long periods, record inflation, and a historically tight labor market. This deduction empowered small business owners and allowed them to not only survive these difficult times, but to thrive. However, small business owners are now confronted with a new reality. If Congress fails to act, the 20% small business deduction will expire at the end of 2025, and over 90% of small business owners will see a significant tax increase. This tax increase will come at a time when their larger C corporation competitors will not be seeing a tax increase, and at a time when inflation remains hugely problematic for small employers. NFIB member Michael Irvin of Coal River Coffee Company in St. Albans, West Virginia, said it best earlier this year at a House Committee on Ways and Means hearing. These tax increases do not exist in a vacuum. My larger competitors like Starbucks and Tim Hortons are organized as C corporations and pay a 21% federal corporate rate, which is permanent. If the small business deduction lapses and my marginal rates increase, I could be staring at an effective tax rate of nearly 45% when you combine federal and state income tax rates. This 45% tax is not a tax on my take-home pay like some high-wage W-2 employees. This is a tax on my business income. With a pass-through business like mine, I am taxed on business income, whether I reinvest that money in my business and create new jobs or take it home as profit. This morning, NFIB, in conjunction with EY, released a macroeconomic analysis of the small business impact of permanently extending the 20% small business deduction. This study concluded that permanently extending this provision would increase jobs in the small business sector by 1.2 million jobs each year for the first 10 years and by 2.4 million every year after. Extending the 20% small business deduction would also result in a $750 billion GDP increase in the small business sector over the first 10 years and a $150 billion increase annually after that. Lastly, recent NFIB research indicates that if taxes were to increase in 2026, 61% of small business owners surveyed reported they would raise prices, and 44% reported they would postpone or cancel capital investments. The decisions Congress makes reflect the values of a Congress. Over the next year, Congress will debate the merits of extending over $4 trillion worth of tax provisions. Members of Congress should ask themselves if they really believe it when they say small businesses are the backbone of America. If they truly believe that statement and value small businesses in their communities, then making the 20% small business deduction permanent should be a no-brainer.
Thank you. I know we're going to have some questions in a moment. Welcome, Mr. Bunn.
Thank you, Chairman Wyden, Ranking Member Crapo, for the opportunity to testify today. Before I get started, I want to recognize Senator Carper for your long service as part of this body and part of this committee. I doubt I'll have another opportunity to testify here before you retire, so I want to wish you well in that retirement. Thank you for your service.
This is off the record, but I just received my first job offer. My post Senate to be Commissioner of Corrections for the state of Delaware, in charge of all of our prisons, so I've had some experience at that.
Excellent.
As the Jewish people would say, oi. Mr. Bunn, welcome.
I think it was an offer made in jest. We'll see.
It may have been.
Thank you.
I want to start by saying concerns about avoidance should be bipartisan, but I think they should motivate conversations about policies that move the tax code into a direction of a simpler, more neutral tax code and away from a complex mess of special deductions, credits, and special provisions for different industries. I think in this conversation, it's important to take a wide lens view of the progressivity of the U.S. tax code and notice that in 2021, the top 1% of taxpayers paid 45.8% of taxes owed. And if you even take a broader view of the entire federal, state, and local tax and transfer system, my team put together analysis looking at 2019 and found a negative 127% effective tax rate for the bottom 1/5 of households and a positive 30.7% effective tax rate for the top 1/5. So the U.S. tax system is incredibly progressive. There's a lot of redistributions that's already there, and I think it's important as we're looking to conversations about 2025 to start with some of those basic facts. You all know that 62% of households will face a tax hike if the Tax Cuts and Jobs Act are allowed to expire. And this is not something that folks are going to be able to ignore. This is going to be very meaningful in January of 2026 as withholding tables adjust and people start realizing that more money is being taken out of their paychecks. This is on the order of magnitude of an additional rent or mortgage payment. Across congressional districts, our team has identified an average of $2,800 tax hike from the expiration of both the individual and business provisions in the Tax Cuts and Jobs Act. And that should, again, as I said at the beginning, motivate a conversation about what should be done and being able to look at opportunities to move the tax code in a more neutral and more simple direction while paying attention to need for additional growth and sufficient revenue. On the neutrality front, the Tax Cuts and Jobs Act, there's a lot of lessons to be learned from that. The lowering of the corporate tax rate, the provision of immediate expensing for business investment, moved the tax code in a more neutral decision. It got Washington out of the boardroom in a lot of senses and allowed businesses to make the investments that they needed. Unfortunately, more recent legislation, including legislation in the Inflation Reduction Act, created more complexity and less neutrality where Washington is picking particular industries or particular investments to provide benefits to. And then even with new regulations for the corporate alternative minimum tax out today, we see that there's a desire to punish certain business types and certain ways of organizing investments and income and just looking for opportunities to provide benefits to others. On the complexity front, I think it's important to look at the individual side of the Tax Cuts and Jobs Act. The doubling of the standard deduction and the limiting of the exposure to the alternative minimum tax saved taxpayers $10 billion in compliance costs. And these are things that should not be ignored going into 2025. There's a real chance that if this Congress the next Congress does not do its work, then millions of Americans, millions of taxpayers are going to be having to hire way more complex and do more complex calculations for their tax returns just to be able to pay when their tax bill is due. And the opportunity to continue with some of that simplification is very real. I'll close talking about a little bit about revenues and opportunity for growth. Looking at the history of the Tax Cuts and Jobs Act, I can't come here and say that the Tax Cuts and Jobs Act has paid for itself, but it has had a lot of benefits. And there's been a lot of interesting things that we've seen in the revenue line items. As the ranking member mentioned, we've been able to see historic levels of revenue. Now, the opportunity is to lean into some of the pro-growth elements that did support these historic levels of revenue and look at things like bonus depreciation, which is the most growth impacting policy that was part of the Tax Cuts and Jobs Act and should be continued. Tax Foundation is here to help. We're here to work through different policy options and think through the revenue and growth consequences and be able to provide this committee and the Congress with opportunities for simpler, more neutral tax policy that supports long-term growth but takes care of our financial needs. And with that, I look forward to your questions.
Okay, very good. And this has been an excellent way to start the discussion, had a cross-section of views. And let me start with you, if I might, Mr. Lord, as a general proposition, because you've been advising people in this area, very wealthy taxpayers. Do low and middle income families, as a general proposition in America, have access to the same kind of advice that you have furnished the very wealthy?
No, they don't, Chairman Wyden, and there's an obvious reason for that. When I helped very wealthy families, they could save, well into the thousands, sometimes tens or hundreds of thousands of dollars in tax, so my fees were just a minor cost. But for a lower or middle income family where the amount of tax they might be able to save with expert advice is, $500 or something like that, they can't go hire a tax attorney. It just isn't cost effective.
Okay. So let's talk a little bit about essentially how this plays out, because I continue to get reports of various approaches, and I want to get your take formally before the Finance Committee. But essentially what I've been told is if you're very well off and you decide to call up your accountant and say, I want to come see you because I don't want to pay income taxes at this point, you can advise them on how they do it, and that starts the glide path to literally paying no income taxes going forward. Is that true? I mean, how does it work? Describe to everybody how this actually plays out when somebody calls you and says their objective is, hey, I heard this buy, borrow, and die. I don't have to pay income taxes. I'm calling you, make sure I don't pay any income this year and next year and the like. Tell us a little bit about how it actually works with a client.
Well, I think it depends on the type of client, but it can be a real estate transaction, how it's structured to minimize the income tax coming out of it. It can be an estate tax client where there's planning done through zeroed out GRATs and other strategies to minimize or even zero out the estate tax liability. It just depends. I don't think I ever had clients where I could consistently run their income tax liability down to zero. It's not that bad, but the amount of income tax that's avoided through strategies like buy, borrow, die is very, very significant.
So you're visited, I assume they have plenty of lawyers and accountants, and you all have this discussion going forward. And how important is it to make sure that there are changes? I've proposed, changes that would make sure that people at the very top pay taxes every year, like firefighters and nurses. That's what people say when they come to a town hall meeting of mine, is they say, hey, I pay taxes with every paycheck. I'm a firefighter, and I'm reading about all these people who aren't paying taxes for years on end. How important is it to make changes in this buy, borrow, and die process, which sure looks to me like a glide path to getting a free ride?
I think it's critically important. Number one, as I said in my opening remarks, when Americans see this, that billionaires are paying a lower effective tax rate than they are, the tax system appears rigged to them, and they lose confidence. But when the ultra wealthy are taxed at too low a rate, they are accumulating wealth faster than the country at large, and their share of the nation's wealth is increasing year upon year, and we've seen that happen with for example, the share of the Forbes 400 over the last 40 years going from 1% of the country's wealth, actually a little less than that, to now about 4%. So it's important on several levels.
So let me ask your colleague, Mr. Dattagupta, is there any evidence that people at the very top are going to stop making good investments if they pay their fair share? I mean, nobody wants that to happen. As I say, I want to reward success. I want to encourage growth. I want to give everybody a chance to get ahead. Are we going to see if we make reforms here so that everybody pays and we're all in this together? Are we going to see those at the very top stop making good investments if they pay their fair share?
No. They're going to have the same motivation for profit, long-term outlook, managing risk, and if anything, we as a country will be able to make much higher quality investments.
Now, one other kind of issue that's come up, and then I'll go to my colleague, Senator Crapo. Is there evidence, any kind, that these kind of, super tax breaks for those at the very top are going to pay for themselves?
No. You're lucky if you can recoup $1 for every $5 or more dollars in tax breaks, which is a stark contrast to investment in children, especially those in the lowest income households, for whom we can estimate you might recoup up to $10 for every single dollar.
I'd like to see your research, your scholarship on that, because if we are paying a premium to encourage unfairness, that ought to wake everybody up. And that seems to me what you're saying.
It's completely upside down. I'll submit it for the record.
Great. Senator Crapo.
Thank you, Mr. Chairman. Mr. Braven, I'd like to start with you on Section 199A. You I think, quite well stated the case for why it is critical that we do not let Section 199A expire, but I'd like to flesh that out a little bit with you. How many signatures were there on the petition? Or was that a letter or a petition that you showed us?
That was a pretty thick stack of petitions, 81,100.
Okay, and those were small businesses?
Yep, small businesses from just about every state in the country, all over the country. We've been compiling these for a number of months.
And so I know that a big part of, there is sort of an attack on Section 199A here in Congress. And I know the attack is that 199A is a 20% basically deduction benefit to really super big, rich taxpayers. I think that's the argument that's being made. Could you tell me if all the folks that signed those 81,000 are those partnerships? What are those?
Those are sole proprietors, partnerships, S corporations, small businesses all throughout America. And the EY study we just released today showed 26 million small businesses claimed this deduction in 2021.
And I guess I'd just like you to kind of address the issue of how many of that 26 million are the super mega wealthy in the country?
Probably not many, if any, because this is from SBA size standards. So they're all fall under SBA size standards. So I'm assuming none of them.
I'd say these are truly small businesses, correct?
Correct.
Well, thank you. I think that that's a pretty important fact to be reminded, that Congress needs to be reminded of. Mr. Dunn, I'd like to talk with you for a minute. I was very interested in your general perspective that we should create a tax code that is simple, that is neutral, and I guess less complex. That's the same, I guess, as simple. But could you explore with me, just put a little more meat on the bones, if you would, how should we approach trying to create simplicity and neutrality in the tax code?
Thanks so much, Senator. The approach that needs to be taken is one of looking at the entire tax code and looking at the complexity and the compliance costs, the billions and billions of dollars in compliance costs, and then taking the approach of, okay, if I'm a family, if I'm a small business owner, if I'm a corporation, how much of the time and how much of my hard-earned money am I going to be investing in complying with the tax code. And then as much as possible, move to a system that eliminates the things that are creating a lot of that complex burden. So I think especially in the business code, this is a ripe opportunity. And unfortunately, we're not necessarily moving kind of on a current rolling policy basis in a direction where things are getting more simple. Some of the revenue raisers from the Tax Cuts and Jobs Act created more complexity, things like expensing for research and development, things that were in the Inflation Reduction Act that I mentioned, the energy credits, and the corporate alternative minimum tax, all have loaded on more complexity. And when it comes to neutrality, it's a question of who's in charge, who wants, this choice or that choice. And it should not be folks in this room. It should not be folks in Washington in general. It should be the individuals, the business owners, the families making the decision of whether, okay, is this the right decision, the right investment, the right opportunity? And at the end of the day, paying the tax that's owed, but not micromanaging those decisions through the tax code, whether it's related to different choices about childcare or housing or investing in green energy or something else. The approach should be to get Washington out of those decisions.
I just have a quick question that came into mind as you were talking. Do you know how many pages of regulations there are to interpret the Internal Revenue Code?
Not off the top of my head, but I do know that it's roughly 600 plus more as of today with the new corporate alternative minimum tax regulations.
That's right. I wish I'd brought that number with me. But if what you're saying is, I think anybody who's tried to prepare a tax return, even just a family, knows that the regulations are so complex and the code is so complex that things like fixing the standard deduction and making that more available, and dealing with the alternative minimum tax have been phenomenally helpful to taxpayers and have not reduced revenue.
Exactly. The Tax Cuts and Jobs Act was able to cut taxes across the board while also really leaning into simplicity for so many millions of taxpayers. I have some charts in my written testimony that show that the massive increase in individuals taking the standard deduction and massive decrease in individuals having to file the AMT. And those are, I would say, marks of success.
All right. Thank you very much.
Thank my colleague. Senator Grassley's next.
Since there's a political purpose behind this committee meeting we're having, I want to make a couple political comments. One of them would deal with the corporate tax that's been brought up here. We all know that a corporation is a legal document. It's made up of management. It's made up of stockholders. It's made up of employees, and the results of the corporation is covered by the consumers. So corporations don't pay taxes. It's coming out of the pockets of all these other people I just mentioned that are corporations. Corporations don't pay taxes. People pay taxes. And you read about various aspects of this impact, but just one of them I'd like to note is the workers. When you increase taxes on corporations, about 50–60% of the tax is going to come out of wages of workers. So you got to look at it as a very anti-worker approach to how you look at the corporate tax rate. The second thing I'd like to make a political point on is I heard during the debate Tuesday night, Vice President Harris accusing Trump through his increase in tariffs, putting a sales tax on people. Now, I don't agree with what the impact of that tariff, but let's just assume she's right. It seems to me you ought to give greater attention to the sales tax effect on the consumers in America. We have a 20% inflation rate. That's a 20% sales tax. That's the most regressive tax that you can have on society as a whole. So we're here talking about progressivity, And we've accepted progressivity ever since World War II of the income tax. And I'm not here to argue against progressivity, but I think you got to look at the regressivity of the tax policies or the fiscal policies of this administration, the impact that it has had on inflation, and that impact on every American very, very aggressive or regressive. Now, I want to ask Mr. Brabant. The Biden-Harris administration has consistently called for significant tax hikes on American small business owners. This includes increasing the top individual rate to 39.6, taxing capital gains as ordinary income, and increasing the net investment tax from 3.8 to 5%. Moreover, their budget proposals have assumed the expiration of the 20% small business tax deduction enacted in our 2017 bill. Can you discuss what this litany of new and expanded tax hikes would mean in terms of jobs and business investments for the millions of small business owners that you represent? And also tell us which one of these would be the most detrimental to family-run businesses?
Sure. In terms of the impacts, recent survey, we just had our members asking them what would they do if taxes increase in 2026, which they could assume a number of these things you just listed would happen. About 66% they said they would increase prices, which you can imagine is going to be problematic with the current inflationary environment. And about 44% said they would cancel or delay capital investments back into their businesses. So obviously it's going to have a drag on the growth of businesses, and it's going to increase prices. In terms of the most detrimental to small businesses, the 20% deduction, 20% small business deduction going away would have the largest impact.
Mr. Brabant, Harris recently proposed increasing the amount of startup costs a small business owner can expense to $50,000 from $5,000. While I'm not sure this proposal is appreciated, wouldn't it benefit? Its benefits pale in comparison to those to be gained from extending the 20% small business deduction or bonus depreciation, which was in the 2017 tax bill.
Yes, I would agree. The small business deduction, and 26 million small businesses took this in 2021. So there's nothing wrong with her proposal, but it affects a much smaller percentage of small businesses, and the small business deduction affects a significantly larger swath of small businesses. So it would have a larger impact on the small business sector in general.
Thank you, Mr. Chairman.
Thank you, Senator Grassley. Senator Bennett's
Thanks,
next.
Mr. Chairman. Thank you so much for holding this important hearing. And Mr. Dedegupta, I've got a question for you about the child tax credit. I know it won't surprise you to know that, but we were able to pass the expanded child tax credit as part of the American Rescue Plan. We cut childhood poverty in the richest country in the world in half as a result of that. We reduced childhood hunger by 25%. It benefited 96% of the families with kids in Colorado and all across the country. It lifted 3 million kids out of poverty, and for a stunning 6 months around here, we were able to demonstrate that we don't need to accept this level of childhood poverty that we have in the richest country of the world as a permanent feature of our democracy or a permanent feature of our economy, that we could actually do something for working people and for their children. I wonder if you'd like to talk a little bit about the value of the expanded child tax credit and the important role that it plays in combating poverty in this country, and also the benefits to middle-class families that it represents.
I would be delighted to discuss that, Senator Bennett. Thank you for your leadership on the child tax credit. This is, over the years, has been a largely bipartisan success. And in the American Rescue Plan Act, we, for the first time, said that we were going to deliver this child tax credit in two really important different ways. One was we would not discriminate against kids because their parents were very poor, which we do otherwise. We had been doing before, we're doing again now. We tell kids whose parents have the lowest incomes when they're struggling the most in life, and often when income is most needed, that they're too poor to receive support from the child tax credit. But for 2021 in the American Rescue Plan Act, we said we wouldn't do that. And then we also started making payments on a monthly basis for many, in addition to enhancing the payment for the youngest kids. So recent research has showed while that was temporary, if we did something like that on a permanent basis, we could estimate that we would recoup as a society about $10 or more for every dollar we spend, especially in getting the money to the kids in the families with the lowest incomes. It turns out, over the long run, ensuring that basic foundation for kids will increase employment and earnings, reduce interaction with the criminal legal system and the costs, reduce interaction with the child protective system, reduce health care costs that the public might bear, and increase tax receipts. So ensuring that basic foundation for all children in this country is one of the wisest investments we could possibly make.
And I appreciate that. And I think, and as a former school superintendent, I don't need to be convinced of the payback to America of lifting kids out of poverty, and I think it's interesting because I'm hearing more and more bipartisan support of a version of this. I mean, the vice presidential candidate on the Republican side is going around saying he wants a $5,000 child tax credit. How refundable that is, I don't know, and that's obviously, in some ways, it seems like staggering that you do it and not do it for the kids that need it the most, especially when we know that their families are almost all of them are working, almost all of them, if not, are living with grandparents who could use the money. But I just think, Mr. Chairman, we have an amazing opportunity in front of us to have this debate. And when I think about the results we saw and the results that we've seen in other countries that have similar child allowances where the work participation rates are actually higher than they are here in the United States of America because people have the money to be able to spend it on child care and stay at work, as an example. It just goes to show you that you can actually make a real difference. And I hope as we get into this debate again, especially when it comes to the question of what are we going to do about this country's deficit, that we understand that we've got real priorities in front of us. When I think about the proposal that President Trump has made to extend his tax cuts, and when you add together the extension of the Bush tax cuts, which I voted against, $8 trillion of deficit extension, the $2 trillion from the Trump tax cuts, the $4.6 trillion that he wants to do if he comes back here again. To me, it's analogous to a mayor in Colorado saying we're going to borrow more money than we've ever borrowed before, which would make all of us in Colorado nervous. You ask them, well, what are you going to spend the money on? What are you going to spend the proceeds on? Because we're nervous about you borrowing all that money. Are you going to spend it on our kids? No. Are you going to spend it on water? That's a huge concern that we have. No. Are you going to spend it on the mental health epidemic that we have as a nation? No. Are you going to spend it on libraries? No. Bridges? No. Roads? No. What are you doing with the money? Why are you borrowing all this money and what are you doing with it? And the answer is we're going to give it to the two richest neighborhoods in Denver or in Grand Junction or in Rifle or in Durango, and we're going to explore any rural county in the state. We're going to give it to the two richest neighborhoods and expect that it's going to trickle down to everybody else. And that the police officers and the teachers and the farmers and the ranchers ought to just expect that their kids are going to have to pay back the debt for the privilege of giving the richest people in America a tax cut when we've got the worst income inequality that we've had since the 1920s. I think funding the child tax credit and doing some deficit reduction sounds like a much better plan than doing that, but we'll see how the debate goes. And Mr. Chairman and the ranking member, thank you very much for having this hearing, and I look forward to the debate that we're going to have.
Senator Bennett, thank you for bringing up the child tax credit. And I just want to note for the record, every Democrat on this dais was prepared to join every Republican in the House on the Ways and Means Committee, and we would have had a package already signed into law that would have given the most relief to large families, which make up 70% of those getting the tax credits. So you're absolutely right about how important it is, and I sure wish that we had gotten a bipartisan agreement here like we had in the House, and this would have been signed into law by President Biden, and those big families would already, as we meet today, have real relief as they begin the school year buying new clothes and sneakers and the like. Senator Langford is next.
Thank you.
Chairman, thank you. I do want to spend some time talking about the Tax Cuts and Jobs Act from 2017, because obviously that's going to be a big issue for next year. There has been some conversation in the presidential election politics lately of saying this only benefited the ultra wealthy and that it wasn't a benefit to everyone. In fact, Vice President Harris has been quoted by Bloomberg as saying that she wants to, what was the exact quote, get rid of the whole thing when she talks about the Tax Cuts and Jobs Act. So I do want to spend some time talking about what does that mean. Mr. Bunn, you had mentioned before a statistic about what's the percentage of Americans that their taxes actually declined with the Tax Cuts and Jobs Act?
So there were tax cuts across the board. And if this actually does expire, 62% of American households will see their taxes increase. And on average, across those households, across congressional districts, that's a tax increase of $2,800.
So 62% of Americans, their taxes are going to increase. The conversation about that we're only going to do a tax increase for people of $400,000 and up, interestingly enough, $400,000 and up 4 years ago versus now is almost $500,000 based on inflation that's just occurred in the last 4 years at this point. So a $400,000 4 years ago would be the equivalent of almost $500,000 now on that, but that number hasn't changed on it. It continues to be able to increase. For the qualified business income that Mr. Brabant, you talked about, that's a pretty significant piece of the Tax Cuts and Jobs Act. You're talking about if the whole thing just goes away, as Vice President Harris is calling for, you're talking about a very significant increase in taxes for every small business in America.
Yep, that's 9 in 10 small businesses are pass-throughs, and over 26 million small businesses claim this in 2021, and they're going to be looking at a significant tax increase if it goes away.
Thank you. I've also been very interested in the concept that the richest, the ultra rich, super rich, I've heard all the different terms, are not paying in taxes. I'd love to bring some facts to the conversation on this, actually from the Joint Committee on Taxation, the nonpartisan committee that this committee has to be able to work with to be able to get our nonpartisan facts. Yesterday, they put out a statement yesterday, just as they're looking back. They looked at 2017 tax bill. The first year after that, they've got all the records for it from 2019 now, from that year to be able to look at it. What happened with the ultra rich in 2019? They looked at the top 0.01% of earners. Top 0.01% of earners, that's 16,000 filers in America, the top 16,000 filers in America, and they said their average federal tax rate for 2019 was a 34% tax rate. Now, this seems very different than what we've talked about before, that the Joint Committee on Tax said the top 0.01% have a federal tax rate of 34%. What's left out of this is obviously the conversation saying, well, we're not taxing them on what they on their unearned income, and that now becomes the joint conversation: is are we going to do an income tax? Or are we going to do a tax that's not really an income tax? That's a tax on what you actually just have. We're going to just tax you on that. That seems to be the point of conversation here. But when we talk about the actual rate, joint tax is telling us the uber rich are paying 34% the year after the Tax Cuts and Jobs Act came in. So I'm trying to be able to process through this, and this is a debate that we've got to be able to have, because we've got to be able to get into next year to be able to establish what is a right rate on this. Several of you have mentioned actually the bonus depreciation piece, which is a piece I work on a lot on it. Mr. Bunn, talk to me a little bit about that bonus depreciation and what that means for investment in manufacturing in America.
So among economists, this is the area where there's most agreement that from the Tax Cuts and Jobs Act, this was the biggest impact for investment, biggest bang for the buck. And looking forward, we've done analysis looking at different options for extending the different policies in the Tax Cuts and Jobs Act. And it is the most impactful, it is certainly still a tax cut, but for per dollar of tax cut, you're getting the most bang for the buck on growth. And it limits the amount of time that different businesses have to think about their depreciation schedules and what assets are in what class and when they're able to get their deductions. It's a real simplification and big bang for the buck on growth.
Yeah, one of the things we did by doubling the standard deduction is simplify taxes for just about every American and trying to be able to process through this. Mr. Chairman, one thing I do want to be able to bring up that we haven't talked about here, but we'll talk about a lot next year because I'm going to continually bring it up, is that we have a bipartisan effort dealing with charitable donations. The 2017 tax bill and the changes that we made there did reduce the number of folks that are able to itemize their taxes for nonprofit donations and charitable giving. Chris Coons and I have worked very hard to be able to bring multiple different proposals on the tax piece so that individuals that are non-itemizers can continue to be able to deduct some of what they give for nonprofits. We have 3 safety nets in America. The family is the first safety net. Churches and nonprofits are the second safety net. The third safety net is government. And so whatever we can do to incentivize people to be able to actually support both families and the safety nets of those nonprofits helps all Americans. And I want to put that in the conversation again for next year.
Happy to continue this conversation. Just want to make 2 points to my colleagues. Number one, the business tax break that my colleague from Oklahoma has referred to would have been taken care of in the bipartisan bill that we had with the chairman of the Ways and Means Committee. So again, as with helping large families, which already could have been done today, so could have been the business break my colleague's talking about. I do want to make sure, because we did this briefly, and I don't think my colleague was here when I discussed it earlier, this analysis that the highest earners are somehow paying a 34% tax rate is based on the funny math you get when you ignore, buy, borrow, and die. And that's what we have been talking about this morning with Mr. Lord and others, is that it is possible, essentially, to go out and buy a bunch of properties and just sit on them and borrow against them for your lifestyle. And then when you die, everything's just recycled. And that's what we're concerned about. This is about tax avoidance. I, too, saw that 34% analysis, and I just want my colleagues to understand that analysis is based on junk math. It's based on funny math that you come up with when you ignore, buy, borrow, and die. All right, our next senator for questions will be Senator Warner. Welcome.
Well, thank you, Mr. Chair.
Excuse me. Senator Cardin will be next in order of appearance, and then will come Senator Warner. I hate to break Senator Warner's
I was
heart.
waiting outside just to make this entry. But as long as Senator Lankford's here, this won't count against your time. I got to tell you, James.
I didn't know you were chair. Go ahead.
No, I'm just going to. No, I just want just 30 seconds. 30 seconds. Just want to say, I maybe even know some people in that 0.01% group. If they're even under what the chairman said, if they're paying 34% even on income, they got bad tax advisors.
I'm going to quit while I'm ahead. I want to thank my colleagues for their courtesy. Senator Cardin will be next, and then Senator Cardin will be followed by Senator Warner. Senator Cardin.
Let me thank Senator Warner. I apologize. I'm chairing another committee, and that's the reason why I'm in and out. But I did want to be here to first thank our witnesses, but also to thank our chair and our ranking member for their attention to the IRS. I've been involved in trying to modernize the IRS for a long time. My friends, Congressman Portman got me involved in that process when I was in the House of Representatives. There was a commission to try to modernize the IRS. We made some very strong recommendations. We made some progress in 1 year, and then it wasn't sustained. And my point is this. Yes, it's a collection of taxes that are owed by sophisticated taxpayers who can figure out ways not to pay taxes, that we have to have the resources at the IRS to counter that. But it's also to recognize that you're not going to change the IRS in 1 year. It's going to take multiple years to get it done. And I know there's disagreement on the IRA bill, but what I thought was the right policy is to give a multi-year approach so the IRS can, in fact, achieve their objective, because they're not going to get it done in 1 year. And to me, that was the strength of any reforms that we want to modernize the IRS. We've got to give them the resources in a multi-year arrangement so that they can, in fact, implement the changes and make the progress that we want. The second thing I want to, and I welcome the thoughts of the panelists, is that in the IRA, it's another aspect of that, which is the direct file system is included in there that helps the average taxpayer that has maybe W-2 income, maybe some interest income, maybe a little bit of Social Security income, that have to pay now hundreds of dollars and spend hours trying to figure out their tax returns, to be able to do a direct file system, and it saves them resources and time, which simplifies it for those who are paying the higher percentages of taxes to start off with than the higher income taxpayers who are being given the advantage because of the unfair sides between their capacity and the IRS. So it's really two parts of the tax reform issues that I thought were important: multi-year to modernize, and helping the average taxpayer so that they don't have to go through the costs and expense and time of filing taxes when they have a rather simplified procedure. So I guess my question, well, I have 2 minutes remaining. I'll be glad to yield back one of those minutes so Senator Warner can have an extra minute time. But is it possible to be able to really get a type of social service-oriented IRS complying with the laws that Congress writes so everybody pays their fair share of taxes as defined by law without a multi-year modernization of the IRS?
I'll just say quickly, thank you for your leadership, Senator Cardin, on IRS modernization issues. It would be very difficult to do that. The IRS has shown with the funding that it did receive that it is now capable of enormous return on investment by going after some of the wealthiest folks who are clearly intentionally evading and avoiding taxes. It has allowed them to enforce sanctions, and it is providing meaningful deficit reduction, which is how it's scored here by nonpartisan scorekeepers. So I think we definitely need to continue fully funding IRS to be able to provide the customer service for those purposes on enforcement, but also for lower income taxpayers. You mentioned direct file. I'm delighted to see that it's been opened up to all states to participate. I really hope they do. We have a lot of information to take the pain out of tax filing, and we are finally moving in the right direction to make this a straightforward process. And instead of going after folks who file for the ITC and CTC at high rates, we should be going after folks above $400,000 and more of income who are actually responsible for a large share of the tax gap.
And let me just advise my colleagues, the direct file was a pilot program authorized under the IRA. Is now being made a permanent program and offered to all states to participate. Maryland is one of the first states that said they will participate on the direct file system that will allow our taxpayers in our state to save resources not only in filing their federal tax returns, but their state income tax returns. I would urge my colleagues to just check with their local, if they're assuming they have state income taxes, to check with their local tax collectors to take advantage of this opportunity, because it can save the state resources and save your taxpayers the aggravations of having to file multiple tax returns. So it was one of the major, I think, advantages of the IRA bill, was to deal with the overwhelming majority of taxpayers who should have a rather easy experience with the IRS. Thank you, Mr. Chair.
I thank my colleague, and particularly for mentioning direct file, because I remember when Dan Coates sat at the end of the dais down there, that was part of the bipartisan tax reform bill we had, and we're going to miss you for a host of reasons, but particularly for IRS modernization issues. You've been invaluable.
Spend my time trying to figure out how to file my tax returns.
Fair enough. Senator Warner.
Well, before Senator Cardin leads, amen to what you just said, Ben, what you've done on the IRS, the fact that we finally got them the resources so they can do some of this modernization. I think direct file is a great new tool. I'm disappointed that we've not had it in Virginia yet. We've urged the state to take it up, and they've not. But these are the kind of common sense, bipartisan, nonpartisan efficiency items that we ought to take on. And really salute. You want to, I interrupted you. You want to?
I know you're not going to qualify for direct file, but I appreciate your strong support on that.
If I did, I might pay that 34%. Well, and with appropriate apologies to the panel, since I got a couple things I want to say too before we get to a question. One, I commend both the chair and the ranking member. We got to grapple with this, and I do hope that we think about some principles before we immediately default to litigating the corporate rate or the top rate alone as a framework. I would, and I'm sure other members have mentioned this, but I haven't mentioned it yet. As somebody who has kind of looked at this issue for a long time, and I'm in a relatively small minority of senators, I can actually read a balance sheet. We're looking at the tax piece. We got to have more revenues. Because partially, and I know people have tangentially touched on this, but the last time we seriously looked at revenues and expenditures was really the Simpson-Bowles Commission. And it was my first gang in the United States Senate. I won't identify one of those gang members. I'm not sure he still wants to claim it, but it was like, I know Mike Crapo, I spent a lot of time. And we thought our heads were going to explode because the debt was going to get to 16 or 17 trillion. We're now at 35 and counting. And frankly, neither political party has any credibility on the issue. But if we look just last year, $1.7 trillion deficit, 700 million of that was interest on the debt. The interest on the debt is going to eat us up. So I do hope as we think about tax, we also think about long-term debt. So I got a couple of notions. One, we had some ideas about long-term Social Security stability, and it looked at CPI, it looked at raising the cap, it looked at actually increasing the bottom quintile for those folks who rely on Social Security entirely. They can't get by at the current rate. But maybe one of the best things that we came up with was on an issue like Social Security, which is really a lot around math, we ought to put in a requirement that we should pick a solvency number, 50 years, 60 years, 70 years, and automatically fix it every 10 years so that we don't kick the can, as we've done since 1983, to who knows when on fixing Social Security, but every 10 years it gets fixed for another future 50, 60, 70 years solvency. That might be a kind of a big idea that we could look at. One of the things, and I echo what you said, Mr. Chairman, my dear friend Michael Bennett has said about child tax credit. There are other investments around kids that we could make. But one of the things we might want to talk about, bipartisan, is, federal government right now on tax policy and direct spending, we spend about $6 per person for everybody 65 and older. Local, state, or federal that doesn't say it's all about the children. We never put our money where our mouth is. So maybe we could start, and Chairman, Ranking, and Ranking members, maybe we ought to say one of the goals of this tax reform ought to be that ratio ought to maybe not be 6-1, but maybe it ought to be 5-2. And then we could argue about how we get there. But if we had something overarching where we said we want to think about intergenerational burdens and obligations, that might be a concept that would be worth exploring. I've shared this with the chairman a couple times. I think, another area, and this is more on the kind of savings side, but we have heard in healthcare about technology improvements for decades. There's not a new drug that doesn't promise savings. There is not a new procedure that doesn't promise savings. There is not a new wearable device that doesn't promise long-term savings. Yet net, all these technology savings never end up driving healthcare costs down. So maybe we ought to think about tax code and other things that incense a technology savings around healthcare. And I know my clock's ticking down. One other, AI is going to be, I think most of us know, the most transformative new technology around. It is going to create a lot of job elimination. From that job elimination, from government and private sector, we ought to figure out a way to recoup some of those savings so they don't just disappear, maybe towards debt and deficit reduction, I'd argue there, but maybe towards actually retraining workers that through no loss of their own or have their jobs eliminated. These are things, kind of ideas that I hope, and I really have great faith in both of you guys and the members of this committee writ large, to see if we could have a discussion at some point about overall goals, and with one of these kind of conversations without mentioning rates at all. That ought to be the tail and not the dog. And my apologies to the panel.
Thank my colleague, and certainly this question of goals and where you want to end up is an important one. Look forward to talking with you about it. Senator Whitehouse is next.
Thanks very much, and thank you, Mr. Chairman, for holding this important hearing. Yesterday, we had a hearing in the Budget Committee on making Social Security and Medicare sound and secure for as far as the actuarial eye can see. And we talked about a bill that I have that would, I believe, accomplish two good things at once. One is decorrupt the tax code, which has been badly infiltrated by big special interest to their special advantage compared to regular citizens. And two, scratch off the worries list of young Americans whether Social Security and Medicare are going to be there for them. So to me, that's a pretty significant priority. In the course of that discussion, Chairman Wyden, who is a member of the Budget Committee, discussed that same strategy and pointed out that there are literally trillions of dollars in available revenue that we lose through what I think the average American would consider to be cheating. Tricks that may be legal, but in which they get screwed. Mr. Didagupta, if you could first give me your sense of, just very generally from a scale perspective, if we tried to efficiently decorrupt the tax code so that big corporations and billionaires and multinationals that can move profits offshore, if we fix that problem, what is the scale of the potential revenue that we could raise to deal with other problems, like, for instance, sound and secure Social Security and Medicare?
Briefly, if you did all of those things, you are looking at trillions, single-digit trillions over 10 years or so. And, of course, you can do other things in Social Security, like raising the cap on payments, and then you have the net investment income tax, too, that targets very high-income folks, very wealthy people, that you could also tackle on top of that. But you're looking at trillions of dollars over a decade.
Yeah, and some of it is pretty basic logical stuff, like it's called the Buffett rule because Warren Buffett legendarily supports it based on the observation that he pays a lower tax rate than his administrative aide, and that kind of doesn't seem fair or economically sensible, particularly if you consider the marginal value of his last dollar compared to the marginal value of his assistant's last dollar. So it seems that that's a pretty good place to look. Do you think that would be the sort of 30% minimum for income in excess of $1 million make sense?
Totally reasonable.
And in addition to whether or not it's reasonable, I'd like to ask you to talk for a minute about the incentives for our economy that we have created by allowing either discounted tax rates or utter tax avoidance when multinational corporations report their income offshore. Strikes me that there's a lot of gamesmanship in how that reporting can be done. There are companies that essentially make all their sales in the United States of America, but claim that all their profits came out of Bermuda or someplace. That seems like it's a little bit rotten. Plus, the incentive is to then move profits offshore, and often accompanied by jobs and so forth offshore. So that seems like a terrible incentive. Plus, there's some money to be raised to do things like defend and protect Social Security and Medicare. What are your thoughts on that aspect of our tax code?
Yes, more than 60% of U.S. multinational foreign profit is harbored in tax havens. There's even
Say
a
that
single,
again?
more than 60% of U.S. multinational.
60.
60.
More than 60%. Go ahead.
The address of a single 5-story building in the Cayman Islands is the legal home of nearly 20,000 companies.
Couldn't be the Ugland building, could it, by any chance?
And the U.S. in particular has multinationals that do this more than others. But this is a global problem. But we were making progress on global agreement.
Those of us who remember my predecessor on the Budget Committee, Kent Conrad, who had a propensity for graphics, big charts, but he also had a propensity for calling out Ugland House, which is a building in a tax haven through which, I'm not going to get the numbers right because I'm working off years ago memory, but through which tens of thousands of corporations allegedly do business, and through which, I think it's 5 stories high, and through which billions of dollars of income go, giving an entirely new and somewhat horrifying meaning to the term small business, if they really think that there are 10,000 businesses operating out of that one little tax haven building. But that's what we're up against. So I encourage you, Chairman, keep it up, keep slugging, let's solve this. Thank you.
I thank my colleague, and I want him to know I'm going to be working in partnership with you because I think you highlighted some of the real-world consequences. Seniors all over this country rely on Social Security. They want to know we're making good decisions, and we talked yesterday under your leadership about some of the consequences of tax avoidance, because tax avoidance in the case of Social Security is going to really hurt the elderly and the disabled in this country, and look forward to working with you. Senator Hassan.
Well, thank you, Mr. Chair, and I want to thank you and the ranking member for this hearing. Thanks to our witnesses for being here this morning. Mr. Bunn, I want to start with a question to you. As you know, Senator Young and I have been working to restore full immediate R&D tax deductions, which expired in 2022. Losing full and immediate R&D deductions has hurt our businesses' ability to compete with Chinese firms, which are subsidized by their government's R&D super deduction. What this means is that when a Chinese company invests $1 million in research and development, the Chinese government provides an immediate $2 million tax deduction. Meanwhile, an American business can now only immediately deduct $100,000 for a $1 million R&D investment. Mr. Bunn, how would restoring the full research and development deduction help American businesses outcompete China?
Thank you for the question, Senator. This is what I would say is the most future-oriented piece of the tax debate, because when businesses are doing R&D, they're thinking about products that many of us have never considered or never figured out like it would be part of our consumer basket or innovations that will be transformative. And when businesses are considering where to make those investments, I think it's important for those investments to be made here in the U.S. And when the U.S. is at a disadvantage because of this amortization of research and development costs, then it means that we are essentially saying, oh, well, we don't necessarily care about future innovation in the U.S. So I think it's incredibly important to lean forward, continue leaning forward on this issue, as you have mentioned, and to be able to make this permanent and restore those deductions for immediate write-offs for research and development.
Thank you. We will keep working to try to do that. We've had good bipartisan support for it. Mr. Dattagupta, I want to turn to you. In your testimony, you reference how investments in housing provide economic opportunity for American families. In New Hampshire, the lack of affordable workforce housing is raising costs for Granite Staters. It's also constraining businesses' ability to hire, invest, and grow. And I want to make clear, this is not just small businesses. Some of our largest employers will try to recruit mid-level or senior-level staff, and they literally cannot find a home to buy or a place to rent in New Hampshire. So, Mr. Dattagupta, what recommendations do you have for how Congress should promote workforce housing in any tax package next year?
Thank you, Senator Hassan. I think one thing that Congress should do is ensure that we encourage more supply of affordable housing. Right. And one could do that in a tax package in part by streamlining and improving the low-income housing tax credit. I will say that it's also important to help with stabilizing rents and potentially with rental assistance in general. But we need both supply and demand side responses. This country is many millions of units short of the housing we need.
Yeah, and it's become an increasing reason that young people in my state are either living at home or moving to very different parts of the country where rental prices are significantly lower, and then starting their careers there. I have another question for you, sir. There's strong bipartisan support for cutting costs for families by expanding the child tax credit, as shown by the House overwhelmingly passing a bipartisan tax cut package this year that was blocked here in the Senate. The package, by the way, had R&D, it had housing, and it had the expansion of the child tax credit. Looking ahead, any future tax package needs to prioritize cutting taxes for hardworking families and lifting children out of poverty. For example, the bipartisan bill that was blocked would have cut taxes for larger families, many of whom are currently unable to get the full child tax credit for each of their children. So, Mr. Dattagupta, looking ahead to any tax package next year, how would making the child tax credit more accessible lower the costs of raising a family?
The child tax credit is one of the single most important ways that we can improve working families' after-tax income, and in particular help them in the periods when maybe they can't work or they work less because they need to do caregiving. But it has allowed families with very little reduction in overall work to afford the basic necessities, whether it's food, rent, clothing, school supplies, and even modest enrichment and activities for their kids that children need to fully develop.
Thank you very much for that. Thank you again to all of the panelists, and thank you, Mr. Chair.
And I thank my colleague for highlighting those areas in particular, because housing, small business, and the child tax credit are all going to be central to meeting the needs of American families, and they all relate to the tax code. So I thank my colleague for doing it. We're going to recognize Senator Carper. I do want the word to go out far and wide, and we've discussed this with the minority as well. We need colleagues to come back because we're getting close to wrapping up, but we want all colleagues who still haven't had a round to have a chance to be heard, so please get that word out. Senator Carper.
One of those colleagues has just stepped back into the room, Senator Johnson. I'd be happy to yield to him.
I'm sorry.
He said he would let Senator Johnson go?
Yes, that in order of appearance, that's absolutely right. And the senator from Delaware is always collegial. And Senator Johnson, please.
Well, first of all, thank you very much, because I've got a noon meeting, and apologize I haven't been here for the full time because this is an incredibly important hearing. Let me state at the outset, I think growing income inequality is a real problem. It truly is. I think we all have to recognize that. Also, I think what's undeniable is our tax code is a grotesque and complex monstrosity. And I guess I come at this from the standpoint, if we were to simplify and rationalize it, we could fix an awful lot of these things. And the example I'll use is, I know the chairman would like to tax unrealizable gains, which I think violates a basic tenet of taxation, wherewithal to pay. There's another way of addressing this, though. One of the problems is about 73% of corporate income is never double taxed. It builds up inside these corporations. I think it distorts our M&A market. So what I've suggested is, why not treat the 5% of American businesses that are C Corps like we do 95% of other businesses, and tax the business income every year at the ownership level. I know C Corps would scream, but it would go a long way toward addressing that particular problem. I've presented that to my colleagues. It's a way of simplifying it. Another problem we have is capital gains tax. It's just an arbitrary number. It really makes no sense. I mean, what's trying to address the fact that it's unfair to tax inflationary gains, correct? So why not just index out the inflationary gains? It's very easy to do, and then tax that at ordinary rates. Now, I just think it's bizarre that we have different levels of taxation for different types of income. From my standpoint, income is income. So that's the direction we ought to move our tax code toward: simplify, rationalize it. Like I said, it's a rational thought to say income is income. You only tax income when you have the wherewithal to pay. If you base things on certain principles, I think that'd go a long way toward fixing things. I did want to ask Mr. Gupta and Mr. Lord, I think both of you complained about stepped-up basis, but isn't it true that stepped-up basis is applied to assets that are subject to gift and estate tax? So if you were to start taxing the stepped-up basis, you're double taxing that. Again, I realize there's certain assets that are not subject to, because they're exempt. You have the personal exemption. But beyond that, it'd be grossly unfair to provide a gift or estate tax, and then on top of that, tax the gain. Would you not agree with that?
Senator, I would respectfully disagree. For a couple reasons. The estate tax and the income tax are two different taxes. We have a kind of a transactional tax system in America. If I get paid wages and then I go to the store and pay sales tax on my purchases, that's not double taxation. But beyond that, the estate and gift tax planning is such that it actually can be accomplished to avoid estate and gift tax entirely and get stepped up basis.
But let me go back. So if you're talking about assets that are income producing, and you go to my system where all income is taxed at the ownership level every year, it's already been taxed. If you're talking about assets that appreciate primarily because of inflation, you ought to be indexing that out anyway. Then on top of that, you throw a penalty of a transfer because of a gift tax, or again, whatever. That's the penalty tax. So, you're transferring an asset to your heir or gifting to somebody. Now we're going to penalize that. Mr. Brabant, can you comment on this?
Yeah, it's a real concern for family businesses, and the estate tax is always a huge deal for family businesses. If you compound this with getting rid of stepped-up basis, there's a real concern that family businesses will more often than not be sold, and usually to larger businesses and who don't have the same footprint in local communities.
Mr. Bunn, you want to comment a little bit just in terms of the irrationality of how we treat different types of income differently? And basically what I'm talking about is, let's simplify and rationalize our tax code. That ought to be, kind of our driving mantra in terms of fixing these things.
Yeah, I would say on stepped-up basis, if you change that policy without changing anything else, it's going to create a lot of significant problems and tax hikes. Some of the problems that Mr. Brabant mentioned. I think generally, though, we're in agreement, moving towards a more simple system, a system that we can, recognize the horizontal and vertical equity, as many public finance folks talk about, and be able to just rationalize things so that compliance and administration are lower cost.
So again, I would just suggest to get focus on areas of agreement. I agree. I think we agree. Growing income inequality is a real problem. I think we agree we have an incredibly complex tax system. So let's focus on that area of agreement, and let's try and make our tax system simpler and more rational, and it'll address a lot of the problem in terms of growing income inequality. Thank you, Mr. Chairman.
I thank my colleague. We're going to go to Senator Warren in just a second, but since my name was thrown around a little bit here in the last 15, 20 minutes on the issue of gains, I just want to present to my colleague that the real question is, are the very wealthy going to be taxed on the income they actually enjoy? And I think we're going to have to work through those issues, and I want it understood that I'm going to work with colleagues on both sides of the aisle to do that. Senator Warren.
All right. Thank you, Mr. Chairman. So our tax code is built on a very simple premise, and that is if you make it big, I mean really, really big, then you can afford to chip in a little more to keep our country going, to help pay for roads and bridges and child care and housing and the things we need. Today, that premise has been turned upside down. The wealthiest of the wealthy have figured out how to get richer and richer and richer and richer in ways that just don't show up on a tax form. The result, the top 1/10 of 1% pays about 3.2% of their wealth in taxes every year, while the bottom 99% pays more than double that. It's just not fair. So next year, Congress has a chance to unrig the tax code Democrats have proposals to stitch up the loopholes that so that we can ensure that the wealthy pay their fair share. But no surprise, the mega millionaires and billionaires are whining that they cannot possibly afford to pay taxes. So, Mr. Lord, you practiced tax law for nearly 40 years. You've advised wealthy clients on how to cut their tax bills. The richest Americans are now paying little to nothing in federal taxes. So tell us, are they not making any money?
Senator, they're making plenty of money, but the way they're making it is by holding assets that grow and grow and grow in value, buildings, stock portfolios and such. And while that wealth is growing, the growth, which is economic income, is not subject, it's not even considered income for federal income tax purposes.
Right, but it's still good collateral for borrowing money.
Oh, it is, and actually they're able to borrow typically at very favorable rates because they have relationships through their business operations with lenders.
Okay, so let's go to that. Elon Musk, for example, raked in nearly $14 billion from 2014 to 2018, but he paid just 3% of that in taxes. Now, that's why the Biden-Harris administration has a proposal to ensure that people with a net worth more than $100 million, we're talking about the wealthiest 10,000 people in the country, that they would pay a minimum of 25% of all of their income in taxes. Now, we all recognize that is well below the current top tax rate of 37%, but the mega millionaires say it's still too high. They don't have the money because their wealth is all locked up in stock. So, Mr. Lord, are these 10,000 mega millionaires actually cash poor? Are they living like monks?
No, they're not. I haven't seen many monks on yachts. No, they're not. This is, as Chair Wyden pointed out, this is buy, borrow, die. When they need cash, they can get it. And as I said before, typically at very favorable rates.
So here are American families who are struggling to pay high mortgage rates and still pay their taxes year after year. Billionaires are buying private jets. Mr. Musk, for example, owns 4. So let us be clear. If you make it big, really big, $100 million or more big, I think you could afford to pay a 25% tax on your income. And just one other part about the choices we're making here. Mr. Datta-Gupta, you are an expert on economic policy and inequality. The Biden-Harris billionaire income tax would raise about $500 billion over 10 years. If we invested that money in things families need, like affordable child care or housing, what impact would that have?
Well, it would be transformative. These proposals that you have also helped champion, Senator Warren, could lower the cost of child care to just $10 a day for most families, helping parents work, helping kids get the early education they need. And research suggests that for every dollar we invest in high-quality early care and education, we could recoup up to $12.
Wow, what an investment. So President Biden and Vice President Harris are fighting for families. Meanwhile, Donald Trump wants to take us even further in the wrong direction. He shoveled out $2 trillion in tax giveaways to the wealthy in 2017. And now he's out there promising that he will reward his, quote, rich as hell donors with more tax cuts next year if he gets the chance. And he and his running mate don't have a clue how to help with the cost of child care. Next year, we can afford to ignore the billionaire tiers. We can raise taxes on the wealthy, and we can invest that money in lowering costs for everyday families. Thank you, Mr. Chairman.
Thank you, Senator Warren. And I come back to the basic proposition that the issue of success and fairness is not mutually incompatible, is not mutually capable of being reconciled. We can do this. We can get this done. We can do both. Okay, Senator Daines.
Thanks, Mr. Chairman. Despite their rhetoric, Vice President Harris, the Democrats are launching a war on our Main Street businesses and Americans who are already living paycheck to paycheck. In fact, Wall Street Journal earlier this year called this the $6 trillion election because we're looking at a $6 trillion tax hike if President Biden's Vice President Kamala Harris and Democrats have their way. From the Vice President's tie-breaking vote imposing an invasive 1099-K requirements, supersizing the IRS, and her call to repeal the pass-through deduction, her record is crystal clear. She's called for an increased death tax and effectively repealing the stepped-up basis, risking the livelihood of Montana farmers and ranchers. She would raise the corporate rate to 28%. This is about global competitiveness. Higher than the EU, higher than communist China, to help fund her tax and spend agenda. Using our businesses as a piggy bank will cost thousands of jobs, make us less globally competitive, and decrease our GDP by an estimated $1.3 trillion. I spent most of my private sector career working for businesses that were competing globally, competing against China. And I can tell you this is a threat to our ability to compete long term. To put it in a different way, for each dollar of revenue raised, the economy loses $1.74, nearly double what it brings in. Vice President Harris also touted her capital gains plan as a less painful version than what her administration previously laid out, but that simply isn't true. In addition to hiking up the rate, she will force small and family-owned businesses to pay the net investment income tax. These businesses would face an unprecedented 5% tax increase on top of what they already pay. If this isn't bad enough, she's pushing for an unconstitutional tax on unrealized capital gains to fund her far-left agenda. Now, the hearing we're having today paints our small and family-owned businesses somehow as tax-evading criminals. Using the tax code to maximize your profit so you can reinvest in your business, increase wages, hire more employees is not wrong, despite what the Democrats may say. Mr. Brabrand, how will small businesses fare in light of these draconian tax hikes? And the top rate's going up about 30% if these Main Street business tax rates are increased under the Harris plan.
It would be difficult for them. A recent survey shows 66% would increase prices, and about 44% would delay, postpone, or cancel planned capital investments in their small businesses.
Under this administration, we have faced record inflation. The debt has skyrocketed, increasing nearly $78,000 every second. They've negotiated a disastrous international agreement, sending U.S. tax dollars to European bureaucrats, while families are struggling with high prices and wages and simply aren't keeping up. As one of my friends has said, the most expensive vehicle the Americans drive today is their grocery cart. Vice President Harris shows no signs of stopping these dangerous policies. In fact, she will accelerate them, despite what she's saying right now. She travels the country running for president, and I'll continue to fight for our Main Street businesses. Mr. Chairman, I yield back my time.
Thank you, Mr. Chairman, and thanks to all of you for sharing your insights today. Since 2017, when that bill was signed into law, there's been a big debate about the impacts of the Tax Cuts and Jobs Act, and the idea, my colleagues on the other side have argued that it was only meant to benefit the wealthy and corporations, which I think is a kind of one of the age-old Democrat talking points, and I don't think it could be more inaccurate. This reform of the nation's outdated tax code, in fact, reduced rates for every income bracket, nearly doubled the standard deduction, doubled the child tax credit, as we all know, for working families, and made American businesses more competitive. And as a result, the economy took off, household incomes increased, the unemployment rate hit its lowest level in 50 years. and businesses returned their operations to the United States. And the list goes on. But what I would argue is that all those gains are going to be lost if Congress doesn't extend the Tax Cuts and Jobs Act before the end of next year. And so let me, Mr. Bunn, begin with you. And I'm sure some of this has been covered already, but on Tuesday evening, Vice President Harris insinuated that extending the Tax Cuts and Jobs Act is nothing more than a tax cut for those at the top, which, as I said, is a familiar talking point. However, as every member of this committee knows, if the Tax Cuts and Jobs Act were to expire at the end of 2025, it would result in a $4 trillion tax hike on Americans in every income bracket, middle-class families and Main Street businesses. Could you outline for this committee what an expiration of TCJ would mean for families across this country and for our nation's economy? And like I said, I know you've probably touched on this already. You did some in your opening remarks, but could you elaborate perhaps and just speak to that issue?
Thank you for the question, Senator. Yes, the Tax Cuts and Jobs Act cut taxes across the board, and its expiration means that will be widespread tax increases. We have a calculator on our website that allows folks to look at how this might look for different family types or income levels. I ran some numbers in preparation for this hearing. A single parent earning $52,000 with 2 kids will see a nearly $1,500 tax increase. A married couple earning $85,000 with 2 kids will see roughly $1,600 tax increase. And these are real impacts that will be felt. You know, that's on the scale of, you know, an extra rent payment or extra mortgage payment, depending on where you live and housing costs in your area of the country. But it's significant.
So could you, one of the other, arguments obviously been made is how the Tax Cuts and Jobs Act distributed among income groups. And if you look at just revenue as a percentage of GDP over the past 50 years, it's averaged 17.3%. If you look at where it is today or what is projected to be in 2024, revenue as a percentage of GDP is projected to be 17.2%. So roughly in the range. And if you, in fact, if you go back to a more narrow time frame between 96 and 2015, it was 17.2%. And then you look at spending and where outlays have gone over the same 50-year period, the average up until 2023, 74 to 23, was 21%. By comparison, CBO projects outlays in 2024 as a percentage of GDP to be at 24.2%. So similar amounts in terms of overall size of the economy, revenue raised by the tax code, but spending up significantly, over 3% relative to the 50-year average. So you can see it's not a question. We run deficits and debt. You look at this problem we have, you put it in perspective. It really is the fact that we're spending a lot more. And it's not a tax issue, it's a spending issue. But what I'd like to have you speak to, if you could, in the remaining time that I have, is this question about how the tax burden distributes across different income categories. The share of income taxes paid by the top 1% in 2001 was 33.2%. In 2021, it was 45.8%. And more specifically, I would like to have you, if you could, talk about just how the Tax Cuts and Jobs Act, because one of the things that I looked at when we were going through this discussion at the time was how does once this is done, the argument was made by the other side is it's going to shift the burden and lower income taxpayers are going to pay more, higher income taxpayers are going to get a big tax cut. I'm curious what the actual experience was in terms of how the tax burden was distributed across income categories. Obviously, if you go back to 2001, you had, as I said, the top 1% paying 33.2%. In 2021, they were paying 45.8%. So, and that was some of the impact, I think, of the Tax Cuts and Jobs Act. But could you speak to that issue? Because I think that's a relevant one as we think about the future and some of the proposals that have been made by my colleagues on the other side to raise taxes even higher on people in upper income categories.
Thank you for the question. So because of the pre-existing situation where we had a progressive tax code and we were cutting taxes across the board. Certainly there were benefits across the board. But as we've seen, as the data you pointed to has shown, the tax burden has become more distributed, more burdensome for the higher income earners since the Tax Cuts and Jobs Act. And this is not just kind of a snapshot kind of thing. This is a continuing kind of trend that we're noticing. And now some of that is due to, in some periods, really high levels of realization of capital gains for high income earners. But this trend is continuing where more of our tax code is leaning in to high income earners. And I'd like to cite, if I may, some work by Brian Riedel at the Manhattan Institute that looks at, if some of the proposals that have been mentioned today have been were really leaned into as far as deficit reduction for higher taxes on companies or higher taxes on high earners, you're still left with probably 2/3 of that annual deficit that's not covered with even leaning into taxes on the wealthy or corporations. So this concept of the gap between our revenues and our spending needs to be much more than about just focusing on the wealthy, and it needs to be focused on some of our long-term liabilities
And my time's expired. Just the short answer to the question is the tax code has become more progressive, not less.
Correct.
Thank you.
I'm going to be real brief and then recognize my friend from New Jersey. I would just say once again that the Vice President made it clear that Democrats are not going to raise taxes on people with incomes less than $400,000. That applies to small business as well. And at the same time, we're not going to let those folks be held hostage to the idea of those at the very top getting another tax cut. And I would just refer my colleagues, because I want to go on to other members, that if you look at what is essentially on the table, the family of small businesses and working families, they're going to get peanuts, and the people at the very top are going to get lavish breaks. And that's what we are not going to support. Senator Helmy.
Thank you, Chairman. And just pulling from your very kind remarks at the beginning, I want to thank you for the warm welcome you've given me and the warm welcome you've given me and the time that we've spent talking about lowering costs of health care and breaking the consolidation of opportunity through the tax code. This is clearly an issue that impacts every New Jerseyan. When we talk about tax policy, we talk about the real impacts of family. I'd like to spend a few moments talking about the SALT deduction. The state and local tax deduction is the only provision in the tax code that allows hardworking homeowners to deduct their property taxes. The 2017 Tax Cuts and Jobs Act placed a cap of $10,000 on the amount a single filer was allowed to deduct from their taxable income. According to the IRS data from 2016, 42% of New Jersey taxpayers claimed an average of about $18,000 in SALT deductions. These are payments that are made to support some of the nation's leading public school education systems, open spaces for families, and other important provisions. This $10,000 cap, these taxpayers lost approximately $8,000 in the deduction, increasing their tax burden by about $1,600 per filer, and that $1,600 figure has likely gone up since 2016. Mr. Dutta-Gupta, if I can ask you, what would you tell this chamber and this committee would be the impact, or the potential impact, sustained by those families of such a large tax increase?
Thank you, Senator Helmy. Well, I think the SALT deduction certainly can be reformed in ways that ensure that benefits flow only to working and middle-class families. And in that case, of course, if we can focus the benefits there, then I think we can ensure that those families can continue to afford their housing, where they live, et cetera. But we do want to be careful. I would tell the body here that without a cap, without other features, the SALT deduction can disproportionately go to very high income families.
But it's fair to say, based on the number of tax filers and proportionate income of those filers filing at a lower rate, the impact is actually much greater proportionally on lower and middle income families than it would be on the higher income families that are a much smaller set of the taxpayer.
It would vary across states and localities.
Thank you.
That could be,
Mr. Lord, again, thank you for being here. And I just want to first recognize the organization's efforts on progressive tax policy and a mention to New Jersey's progressive tax policy made better by Governor Murphy's focus on equitable taxation. If I may speak on the IRS has long been depleted of its proper resources that provide the agency the capability and the capacity it needs to simply fulfill its duty and properly ensure all Americans pay taxes they owe. In the fall of 2023, the IRS launched a new initiative funded by the IRA to target wealthy individuals and significant unpaid tax debt. Dozens of senior staff were assigned to focus on those cases involving taxpayers earning over $1 million and owing more than $250,000. Previously, the IRS has struggled to collect from those individuals due to resource constraints. After recovering $38 million from over 175 wealthy taxpayers last year, the IRS has expanded this effort to include more than 1,600 high-income individuals. So far, nearly 80% of them have made payments, leading over to $1 billion in recovered taxes, an increase of $100 million since July, when the Treasury and the IRS first announced the $1 billion landmark. Mr. Lord, can you expand on the impact of properly funding the IRS and whether it provides for an efficient anti-tax avoidance strategy?
Be happy to, Senator. And going beyond your remarks, when we're looking at containing tax avoidance by the ultra-rich, it's an ongoing process. Congress passes tax legislation, and there always will be smart tax lawyers out there that devise strategies to reduce taxes for the ultra-rich. They see the loopholes, and they figure out how to exploit them. And so the next step in the process is the IRS is out there, fully staffed, conducting audits at a sufficient level, not just to collect revenue, but to detect these avoidance strategies. And then the next step after that is for Congress to come back and deal with the loopholes, close the loopholes. And it's an ongoing process. It will go on forever. Tax lawyers and other tax experts will always be devising strategies. I was asked about this by a reporter a couple months ago, and I said, it's kind of like this ongoing game of cat and mouse. But what's happened over the last several decades is the cat stopped playing, and the mice are feasting on the cheese.
Thank you, Mr. Lord. Thank you, Mr. Chair.
You're welcome, and welcome to the committee. This is a great committee, and I think you'll have the honor of serving on it for a couple of months, so make the most of it. All right. Let me telegraph a pitch, if I could, and I'm going to ask a question, and I'm going to give him some time to think about it, and then I just want to think out loud as I've listened to this hearing today. I'm going to be asking a question of Mr. Lord, of you, in a few minutes. And the question is, can you provide a general overview of the improvements in IRS capabilities since the Inflation Reduction Act's implementation, particularly in addressing high-income tax evasion? And can you speak to what further investments or policy changes you might recommend to build on those successes? So just be thinking about that. And I'm going to say, let's talk for a little bit, and I'll come back to you to respond to that question, okay? All right. I'm a recovering governor. I was privileged to be governor of Delaware for 8 years, served as the chairman of the National Governors Association for part of that time. And one of the things I most enjoyed doing as governors, working with other governors. And we had an entity within the National Governors Association called the Center for Best Practices. And it's a vehicle that enables states to borrow ideas from other states and share ideas that work or don't work. And if I'm one of the pieces of advice I'd recommend for this committee going forward, and I think we have great leadership on both the Democratic and Republican side here, but to look to the states, I always like to find out what works, do more of that, and the idea that states are laboratories for democracy, and we could probably learn some things from them with respect to tax policy, because they all have tax policy. One of the things that happened during the time I was governor, we had something in Delaware called the Delaware Quality Award. It was awarded every year to, it could be a nonprofit, it could be a governmental entity, it could be a company. And my last year as governor, the Quality Award of Delaware was awarded to the Delaware Division of Revenue, which is like the IRS in the state of Delaware. And they want it because of the kind of customer service that they provided, we provided to the people of our state. And I think we talked a little bit about Direct File as an entity that will help us provide a better service to folks. And I'm very proud of my staff and the work that we were able to do on Direct File to make sure that it is made permanent and hopefully more effective going forward. There's an entity called the General Accountability Office, GAO, that's been around forever. They are going to be doing some serious work over the next couple of months, because when the new Congress comes into office and new administration, they're going to be submitting to us something called a high-risk list. High-risk list, which is, I've used it as chairman of the Homeland Security Committee as a to-do list. And to the extent that the GAO, who does great work, they have smart people, to the extent that they can provide advice on these issues that we're discussing today, it could help get us closer to kind of bipartisan consensus that we're going to need if we're going to actually succeed going forward. One of the other stories I've shared with, I haven't shared this in this committee before, but Joe Biden had been president for like a week. Going back almost 4 years, and he called me. He's always called me Tommy. We've known each other for like 50 years. And he called me, he'd been president for like a week, and he called me and he said, Tommy, I have something I want you to do. And I said, yes, sir, Mr. President. And he said, I want you to bring over to the Oval Office within a week the relevant members of the Homeland Security, rather the relevant members of the Environment and Public Works Committee, which I chair now, that would help us put together an infrastructure bill, a comprehensive infrastructure bill. But he said, bring Democrats, bring Republicans, and come and meet with me and some others. And a week later, I showed up and brought with me a number of folks, including Ben Cardin, who sits to my right here, Shelley Capito, who's the ranking Republican from West Virginia, Jim Inhofe, who was on the committee at the time, the late Jim Inhofe. And anyway, we showed up and we met with the president, we met with the vice president. Vice President Harris was with us. Mayor Pete, I still call him Mayor Pete, Secretary of Transportation. And the president said, we all know we need to do work on infrastructure, roads, highways, bridges, water, wastewater, and so forth. And he said, I want to try to provide some leadership, and my administration provide that leadership. We're going to have a new president. We'll have different ideas who we would like to see to be the next president. But I know who I have, who's my pick would be, and not everybody would agree, but I think some would. But in any event, my advice to the new president will be that if it's Kamala Harris, my advice to her will be the same thing with the tax reform that Joe Biden did with respect to infrastructure, and to make it a bipartisan issue, do it early on, say this is a priority, and commit the time and effort to make it happen. Let me say one other quick thing here. The last thing I would say is it's really important. We've been joined by Senator Barrasso, one of my best buddies, but one of my things that I learned as governor a long time ago is pick the smartest people you can find, smart, honest, hardworking, able to build consensus, and put them in office. Danny Werfel sat at this table, about a year ago, when he'd been nominated to be the commissioner for the IRS. And he's done, I think, an extraordinary job. Very proud of the work that he's done. But it's important who who presidents nominate to serve in these jobs. And who gets confirmed. I'll close with this, if I could, Mr. Chairman. Thanks for giving me the gavel for a minute. But in the next Congress, I think you've probably already done this, but the idea of having a series of hearings where we bring in previous IRS administrators, Democrat and Republican, to sit out here at this table and to share ideas with us on and on, maybe on more than one occasion, I think could only be helpful. Thank you. It's been an honor to serve.
Did you already discuss that idea of having the past administrators?
Oh, yeah.
Senator Carper, always full of good ideas. He knows I'm going to call him often when he's in his so-called retirement.
Thank you so much.
Senator Brasso.
Thanks so much, Mr. Chairman. And Mr. Brower, let me start with you, since I've been a member of the National Federation of Independent Business when I was practicing medicine in Casper, Wyoming. Our Casper Orthopedics was a proud member. And so there are a couple questions, things I'd like to talk with you about in terms of what's happening here. Plenty of talk on the numerous tax increases that are facing small businesses coming to 2025. Republicans have been very loud and clear that we're going to do everything that we can in our power to make sure these tax increases never happen. We've talked about the death tax, the expiration of the small business tax deduction, increased tax rates across the board that would impact small business owners. To go even further, though, Democrats seem to want to add to that uncertainty that is facing the country and threaten small business owners with a new supercharged death tax, increased capital gains rates, an additional 5% surtax on small business income. And I mean, this to me looks like a plan to strangle small businesses. So are you hearing from small businesses and the owners about these provisions, and what are they telling you about the 2025 expirations on some of these new tax hikes that proposals that are being threatened?
Thank you, Senator, and thank you for your NFIB membership. Really appreciate it. What we've heard from members, and there's so many different provisions out there, they're just generally aware a tax hike is coming, and what they have told us is about 66% of them will increase prices if this tax hike increases. About 44% will cancel or postpone planned capital investments. And then other businesses, there'll be other options, which will be they won't hire as many people. They potentially won't be able to increase benefits as they had planned. So it's going to have serious consequences for the small business sector.
So the things I mentioned that you mentioned are inflation, increased prices, hiring fewer people, higher unemployment. So what impact are these tax proposals then going to have on our broader economy?
Yeah, I mean, they could have a significant impact just in the small business sector. If the 20% small business deduction expires, we would lose a potential growth of $750 billion over the first 10 years. Because if we make it permanent, that's where it's going to go. And we're going to lose potentially 1.2 million jobs that would have been there otherwise per year.
So I travel all around Wyoming, talk to farmers, ranchers, small business owners. On Labor Day, I was in the small town of Meeteetse, Wyoming, a town that's so small that the high school football team plays in the 6-man division because that's as many students as they have to be able to play. And one of the things that keeps them up at night is hearing this stuff about this stepped up basis. Many operations across Wyoming and small business are generational. The Biden-Harris administration has proposed this supercharged death tax. If my colleagues on the other side of the aisle have their way in 2025, they'd allow the current death tax exemption to expire. When I hear about this in Meeteetse, Wyoming, this has really gotten out a long way from Washington for people worried about what Washington may do that's going to apply their freedoms, their life, their livelihood. Are you hearing the same thing from members of NFIB about keeping the current death tax exemption in place, as well as concerns about these new supercharged death tax, as well as this stepped-up basis?
Of course, if you get rid of stepped-up basis and you have an increase in the death tax, you're looking at, as you mentioned, a little bit of a double death tax. Our members who are nearing retirement, this is a critical issue for them. So nearing the end of life, critical issue they're very concerned about. The concern for the small business sector is often these small businesses are selling these businesses because they can't afford to pay these taxes to what often happen to be larger businesses who don't have the same footprint in these same small rural communities you just discussed.
Yeah, we have a group of the Centennial Ranch group. We have a celebration each year for those that have kept the ranch in the family for 100 years in Wyoming. And Wyoming has only been a state over a little over less than 140 years. So these are families that have been through drought, fire, terrible winters, all of it. And yet their biggest threat to continuing in the family is the federal government and what they're doing along those lines. So I appreciate your comments on that. Mr. Bunn, if I could ask you a question as well. There's been a lot of talk about people who, quote, avoid taxes. When you look at the data, instead of listening to the misleading rhetoric that we're hearing, it looks like high-income earners shoulder a massive amount of the tax burden in this country. It doesn't seem to be as much tax avoidance as we would be led to believe if you look at the headlines or listen to the people on the other side of the aisle. Recent data from the IRS says that we have a highly progressive tax rate and that the top half of income earners paid almost 98% of all federal income taxes. The bottom half of income earners pay about less than 3% of all taxes. You look at the top 1% of income earners, that's 26% of all the taxes. The Joint Committee on Taxation pamphlet published on behalf of the Finance Committee for this hearing also has some interesting statistics. What should unrealized gains not be considered as income? I mean, this to me makes no sense at all. You know, I would think that unrealized gains should not be considered of income. And Senator Langford talked about that a little earlier.
Yeah, so this is really a question of like what you mean when you talk about income. In this conversation, there's been terms like economic income thrown out or just general income. And for me, thinking about the future of the tax code and the direction we should be going, we should be thinking about things like consumed income, income that's available for you to use in your daily life and in your consumption. And leaning into unrealized capital gains is the exact opposite direction than moving towards something like a concept of consumed income. And taxing unrealized capital gains would add additional complexities to the tax code, both on the compliance side and the administrative side, and a lot of uncertainty for taxpayers along the way.
Thank you, Mr. Chairman.
I thank my colleague, and before he leaves, because I've repeated this a few times in the course of the morning, this whole question of gains, to me, really comes down to the proposition, which I hear in Oregon, and I assume Wyoming and elsewhere, are those at the very top going to be taxed on the income they actually enjoy? Because that's the way it works for all our nurses and firefighters and teachers, and I'm hoping we can do some bipartisan work on this. And let me thank our panel. I think they know this has been kind of a jumpstart, a preview of the extraordinarily big and important tax debate that is ramping up for next year. As we indicated way back almost 3 hours ago, my concern is that Donald Trump is essentially waging a class war against these working kind of families, because the breaks are all going to people at the top, a disproportionate number of them. This is going to add, under the Trump proposal, $4 trillion to the deficit. People at the top would benefit. And we feel very strongly on our side, and this is what was bipartisan years ago, is we want a tax code that gives everybody in America the chance to get ahead. That's when we're at our best, when you give everybody a chance to get ahead, not just chicken feed for the working families and all the breaks for the people at the top. And we've got big needs, particularly in terms of child care and housing. And I think buy, borrow, and die, as we've talked about here, is really representative of the kind of avoidance kind of strategy. As I asked Mr. Lord about this, he was a practitioner, and he has people coming in and essentially trying to work through how to pay little or nothing, not just for a year or two, but for all practical purposes, because things get recalculated when somebody passes pretty much forever. And that is certainly not America at its best. Our country, I believe, is in this together. We talked some about China, and if I had had my way, we would have had a bipartisan bill signed into law already that had the research and development tax credit, and we'd be in a stronger position to compete with China. So my door is open to working with my colleagues. I just want it understood that we're going to have to show that success and fairness, it's not impossible to have both. We can do it. That's, to me, what the challenge is all about and what I'm going to pursue. Will our new colleague like another opportunity to say something?
No, thank you, Chairman, but thank you for those remarks.
All right. I thank all of our witnesses for coming. This is the beginning of the discussion, far from anything that's going to be a one-off proposition. I thank them. We look forward to working with you all in the days ahead. And with that, we're adjourned.